In the last 6 months to September 2020, our overall petrochemical volumes total over 4.4 million metric ton, up 17% over the same period last year, while average open interest stood at over 1.38 million metric ton, up 9% year-on-year. What's interesting to observe is that in January 2020, prior to the coronavirus outbreak becoming a global public health concern, the open interest averaged just below 1 million metric ton. As we entered into February and March, and the outbreak became more widespread until it was declared a pandemic in early March, open interest quickly rose and peaked at 1.45 million metric ton in April, before stabilizing at the level we are seeing today. This indicates that there is increased use of our petrochemical derivative contracts as effective risk management tools during heightened market uncertainties. The oil price crash in March was a second blow to the market already reeling from the disruptions in supply chains caused by lockdown measures implemented by governments to contain the pandemic, creating unprecedented volatility in various markets, including petrochemicals. The volatility in the physical prices of petrochemicals has contributed to the increased need for risk management. Volumes traded on SGX in March surged to almost 1.4 million metric ton, more than double the volumes in February as well as from the same period a year ago. The surge in our petrochemical volumes in March was seen across all our key petrochemical products, from paraxylene, benzene, styrene monomer to monoethylene glycol. Yes, absolutely. As we have seen in March, an increasingly more volatile and uncertain market could drive greater use of our derivative contracts as market participants turn to our hedging instruments to provide them with effective tools to shield them against the underlying volatility. Other factors that are also important to drive greater usage of our petrochemical derivative contracts include more proactive risk management policy arising from in-depth understanding by market participants of the other benefits that can be derived from using our derivative contracts, in addition to the benefit of using the contract to manage price risk. These other benefits include: firstly, reduction of counterparty credit risk. By using our contracts, market participants will no longer have to face the credit risk of the counterparty of the trade, since SGX will now come in the middle of the trade by becoming the central counterparty, meaning becoming a seller to the buyer and a buyer to the seller, effectively guaranteeing the trade. The importance of this benefit cannot be overemphasized, especially in the current highly uncertain climate, which have seen a few market participants going under as a result of these twin black swan events. Secondly, simpler trading arrangement through a single trading account to trade with multiple counterparties. In a bilateral trading arrangement, market participants will have to open multiple ISDA agreements with various counterparties, leading to more complex bilateral relationships, which will not only need to be managed actively, but also limit market participants' ability to enjoy more trading opportunities as well as subject them to the counterparty credit risk mentioned previously. Lastly, more efficient use of capital through our robust margining system. Through a single trading account as described before, market participants will be able to nap off their opposite positions as well as enjoy suitable margin offsets for correlated products that market participants may hold at the same time, leading to a more efficient use of their capital. We have a suite of 5 petrochemical products: paraxylene, benzene, styrene monomer, monoethylene glycol, and methanol, which we recently launched in February this year. Our strategy has always been to launch products that will address market needs for suitable risk management tools for a particular segment of the market, grow the liquidity of these products by engaging and educating market participants on the benefits of using these products, and entrench the liquidity further by introducing adjacent products and offering cost synergies with other product offerings. Of the 5 products mentioned earlier, paraxylene and benzene are the most mature and liquid products, with both products making up about 80% of our total volumes. Our priorities at the moment are therefore to develop further the newer products such as styrene, monoethylene glycol, and methanol, while at the same time looking at opportunity to introduce adjacent products for paraxylene and benzene. In February 2020, SGX launched methanol derivative contract, a new segment in our petrochemical product offering in response to an increasing demand for methanol in China, one of the largest producers and importers of methanol, with imports of 10 million metric tons of methanol in 2019, which are expected to continue to grow in the next decade. The increased methanol demand from China is attributed to the Chinese government's increasing focus on the use of cleaner products, which drive the increased usage of methanol in direct fuel blending, as well as the growth of methanol to olefin plants as an alternative route to the more traditional petroleum-based steam cracker plants to produce ethylene and propylene. With the world now trending towards decarbonization, methanol is set to play a bigger role in the future, potentially as a cleaner alternative marine fuel. SGX is pleased to have launched this product and will continue to work with both the petrochemical and the shipping industries to develop greater usage of this product in the respective markets in the future. Likewise, SGX is also open to introduce other products that will help address the industry needs, including ESG-linked products such as the plastic waste to fuel product, in line with our corporate policy which broadly supports green initiatives.